Hello everyone, it's Fun here again. Today we'll be talking about how you can use stocks as economic indicators, and we'll also be talking about a weak dollar versus a strong dollar. So getting started, there are different kinds of economic indicators. There are leading indicators which tell you what is going to happen. There's coincident indicators which tell you what is happening right now. And there's lagging indicators which tell you what has already happened. So these three ones are the economic indicators. So as for stocks, they are leading indicators. Okay, stock prices are leading indicators. They are actually based on the future. So the stock market will tell us how the economy is going to be. And that means if they're based on the future, you cannot buy stocks based on what's happening today, right? If someone says right now, buy now, that is too late. Okay, it is too late. Today's news is too late for you to be buying stocks because they're based in the future, right? So anything in the present is not going to catch up. And in fact, stocks can actually rise during a recession because the exchanges and the people who trade the stocks believe the economy is going to get better. So at the end of the day, what's happening right now does not reflect how the stock is going to be, if that makes sense, the stock's price. It's fun for the future. What I mean by this is that what is happening now to the company is not what is happening now to the stock's price. If the company is going to announce a big, innovation or whatnot, yes, that's going to affect the stock's price, but what I'm saying is right now, what is happening to the company is not affecting the stock price right now. Hopefully that makes sense to you guys. Yes, if a company announces some crazy, future plans, that's going to affect the stock's price because it's looking into the future, right? But I'm saying currently what is happening is not affecting the stock's price currently. Hopefully that makes sense. Just want to clear that up. And a stock could drop like 10% today, but the company is no different than yesterday, right? It's all about the future. So again, stocks and their prices are based on its perceived value in the future. Now, stocks are often grouped in these things called indexes, where they just track a list of these different securities, okay? So the most common ones that you probably heard of are the Dow Jones, S&P 500, and NASDAQ. At least I knew I heard about this before even knowing about stocks and stuff like that. Now, the problem with indexes is that they don't tell the whole story, okay? If people often use indexes to track how our economy is doing, but the Dow Jones has 30 stocks in it. So if one out of those 30 stocks were to go, lower or something really bad happens to that, of course Dow Jones is going to get impacted. But that doesn't tell the truth about our entire economy, right? That one company does not represent 1/30th of our entire economy, unlike how it would for the index. So hopefully that makes sense. It's just a small fraction. Yes, it can be used as a reference to understand what's happening to our economy, but the bigger the pool that the index lists and tracks, the better and more accurate it is. Now, Edelman also thinks that we should invest in international companies because the world economy is growing and that the US stock market is actually often outperformed by other nations. So he recommends that we invest in blue chip stocks, which just are like the biggest, largest, most stable, and advanced companies that are internationally. And in fact, there's only 140 companies of the Global 500, the Fortune Global 500, are actually US based. So we do have the most, but there's tons of other money out there, right? So there is, a catch and a risk to international investing. And it's that when you buy a foreign stock, you're going to require that foreign currency, right, to purchase that foreign stock. This means that your investments are subject to both the stock market fluctuation and the foreign currency exchange rate fluctuation, right? So what's good here is that if a company is worth more in its foreign currency, obviously you make more money, right? But what can also be good is if the foreign currency goes up compared to the dollar, because now the foreign currency is worth more or getting closer to the dollar, meaning that whatever gains that company makes, that foreign company makes, is closer to the dollar, meaning that you make more USD, right? Now, what could be bad is that the company could be worth less in its foreign currency, meaning it's not doing so good, and that the foreign currency goes down compared to the dollar. So now your dollar is worth way more than that foreign currency, so whatever gains that foreign currency made is not much compared to your dollar, right? So hopefully that makes sense to you guys. I could, write something in the comments if you guys still don't understand that, but there is that risk where you have to have that exchange rate. So now we talked about, the dollar getting stronger and weaker. So weak dollar or strong dollar, this is a common debate that people have, and I'm just going to tell you what they mean. So what a weak dollar does is It's cheaper for foreigners to buy US investments and products. This means that it's good for manufacturers in the US because they can get more sales since products are cheaper worldwide, right? And the downside is that the US government is going to have to issue more debt than normal because of the weaker dollar, right? The dollar's getting weaker, so to issue more debt to compensate. So interest rates are going to rise because of that. Then that's going to cause inflation, and then that's bad for the economy. So as you can see, this is not looking so hot for our government. So in the end, it's good for US businesses and US investors invested in international markets, right? Because the dollar is weaker, that means that their foreign gains that they have, from their investments are closer to the dollar or even worth even more, right? So which is good for them, but it's bad for US consumers, and vice versa could be assumed for the strong dollar. So recapping everything that we learned, first are that stocks are leading indicators, right? They are based on the future. Next are that stock market indexes are just a list of stocks, and they do not represent the entire economy, okay? But they are helpful in tracking. And that international companies are worth investing in, right? You just have to be wary of the risk of the currency exchange rate fluctuations, and that a strong or weak dollar, no matter what, you can't make everybody happy, okay? Some parties are going to be happy, some won't. So that's that. So thank you guys for watching the video. Like, subscribe, do what you will, not obligated to do so. And I'll catch you guys in the next one. Thanks.